Hi there, everyone. Happy Wednesday, February 5th. Welcome to Chart This with Dave Keller. I'm your host, Dave Keller, coming to you from a snowy winter wonderland that is Redmond, Washington. We've got 6 feet of snow, 6 inches, not 6 feet, 6 inches of snow on the ground. I had my daughter measured it with a ruler earlier today to confirm for all of you, and we've got another 2 to 6 inches apparently coming overnight. I don't have to tell you if you're familiar with this area, we do not deal with large amounts of snow very well. Schools are closed, grocery stores are running out of stuff. It's down to Lord of the Flies level, fall down in basic functioning here. But good news is we got a lot of snowman and snow people running around the yards. Dog is enjoying it very much. We are just trying to stay warm, stay safe, get through the flu, and enjoy this tumultuous week of equity prices. Thanks for joining me, in all honesty, on the show today. Can't tell you how much I appreciate you guys tuning in live. We're live streaming on Facebook, LinkedIn, YouTube, and X. And you do have the opportunity to ask questions. Anywhere you can put comments on those platforms, just put a question as it comes up during the first part of the show. And at the end, we'll take a question or two. And anything we don't get to, we will put in the final bar mailbag. Have some really good questions I've already started to pull for Friday's episode, and would love a couple more good ones. So keep them coming as we go through the charts today. Overall, I think what you'll learn on a day like today, the Nasdaq actually spent much of the day in the red, did actually end up being slightly positive at the end of the day. And that was in the last 20 minutes of trading, saw a big spike higher. You're going to compare that to the Dow, which was basically after opening lower, just this nice kind of consistent uptrend. So Dow over the Nasdaq back in play. Volatility still in low levels. Gold continuing to press new all-time highs. Bonds, a bit of a shift there. And we're going to talk about what the charts are telling us, basically showing a nice upside follow through on the TLT, which implies a breakdown in the 10-year yield, breaking down through trendline support. So a lot of charts to get to here as we go on with our market recap. All right, so here is the little 2-day preview chart of the Dow. You can see what I'm talking about, right? Here's the lower open around 10 a.m. Eastern. We make the lows of the day, and then the whole rest of the day pushing higher. We'll look in a moment at what stocks actually drove the Dow higher, but the Dow ended up being the best performer out of the three major U.S. indexes, up 0.7%. The Nasdaq Composite up slightly, 0.2%. That really came in the last 15 minutes of trading. The S&P did close 0.4% higher to close just above 60.61. Mid caps, small caps all up as well. And basically mids and smalls tied for the best performers, both up just under 1% for the day. The VIX moved lower by about 1.4 VIX points, ending the day around just below 16. So at a 15 handle for the VIX, that basically means low volatility, low uncertainty, low concern. I mean, if you would have told me all the things happening in the last week and a half, from Trump with tariffs, with the Doge taking over federal agencies and cutting a bunch of spending aggressively, all of the geopolitical issues implied by the tariffs. I mean, DeepSeek AI is like down the list of crazy things that have happened in the last week and a half. If told me all those things were going to come out and the VIX would still be around 15, I think you're nuts. But that's the case. And again, that's why what I've often reminded myself is that the market doesn't care what you think will happen to different indicators and different charts based on different macro themes. And I think that's something you have to be careful with. That's why when I interview someone for my podcast and we talk about the potential impact of tariffs or tax policy or higher or lower rates or Fed rate cuts or Fed rate hikes or all these things, it's all conjecture. It's all, making a bunch of assumptions. It's modeling what could happen based on market history. But at the end of the day, the markets do what they do. And that's why I find charts are so helpful. They are great myth busters for what we think should happen based on some news flow. The charts tell you what's happening. They are fact. They are not conjecture. It's not opinion. It is fact that price occurred at a certain level. The buyers and sellers came together. So keep looking at the charts. That's my quick version of that. We can see looking at interest rates. Now, rates have come down here in the last couple of weeks, and we're starting to see them, I think really start to break down. The 10-year yield currently around 442. So we've taken out 4.6%, 4.5%. Now we're down to 4.4%, almost through the course of the day today. I would argue the 10-year Treasury yield, which we featured, I think, on yesterday's show, we highlighted that trend line that we were at the lower end of that trend line channel. We actually broke down through that exact trend line today. Today, I grabbed a chart of the TLT, kind of that the 10-year yield flipped upside down. We're going to be looking at bond prices, but you'll see how improving momentum, how improving trend is really changing the trajectory of bond prices. The stock to bond ratio, while still favoring stocks over the long term, very clearly so. In the short term, favoring bonds over stocks, as bonds have rallied and stocks are faltering a bit after attempting to make new all-time highs above S&P 6100. We'll go through those charts in a little more detail later, but bonds did move higher, about 1.7% for the TLT. Dollar index, no real change from yesterday using the UUP. It's a dollar ETF. Commodity space, a bit mixed. Precious metal side and industrial metals, all good. Gold and silver continue to push to new highs. Copper up 1.6%. On the energy side, crude oil prices lower. The USO was down 1.8%. Gasoline ETFs as well. Looking at cryptocurrencies, kind of mixed here, but Bitcoin, I mean, not particularly good, and now faltering below that 100,000 level. In the short term, again, as we mentioned on yesterday's show, and I think as we dug into it a good amount, I think with the S&P, with Bitcoin, I'm very much getting consolidation vibes. I'm not getting bull market trend where we're making higher highs and higher lows. Charts like Meta show what that looks like. That's not where we're at. Chart of Cisco, which I grabbed for today, kind of up and to the right. That's not what the S&P and the NASDAQ are doing right now. They're sideways. And it's not a downtrend, right? There are stocks that are going down, but the S&P and the NASDAQ are holding support levels, are holding those recent lines in the sand. So I think with cryptocurrencies, with Bitcoin, with the S&P and the NASDAQ, we're going that painful third direction. We're going sideways. And to be honest with you, given all the competing narratives, giving all the uncertainty and sort of this feeling, and I don't know how about you, but every morning I kind of fire up the laptop, I look at some charts, I look at news, and I'm just wondering what headline is going to hit. Some random thing I did not see coming from the new presidential administration. Whether or not you agree with what is being done, I don't want to get to that. But I would say there is definitely an uncertainty to it. And the markets generally like certainty. They don't like uncertainty. They like stability. They don't like instability. So I think the uncertainty of everything going on, a lot of things are so fluid. It doesn't seem clear as to where this may go and the long-term implications of some of these decisions that are being made. And then I think that nets into risk assets being kind of in a tread water mode. I think the markets are telling you we're not clear what the impacts are going to be. So, I think we're in wait and see mode. We wait to see which way the momentum leads us out of this range. But for now, Bitcoin, just like with the S&P and the NASDAQ, kind of remaining sideways. Looking at sectors, you can see one of the most defensive sectors I would list out for you, real estate. The XLRE is in the leaderboard, top of the leaderboard today, up 1.6%. Technology, a frequent appearance on the top of the leaderboard in 2024, back there today, up 1.4%. Financials, number 3, up 1.1%. Only 3 of the 11 S&P sectors finished today in the red. Consumer discretionary down 1.1%. Communication services down 1%. And materials essentially flat for the day, just slightly below yesterday's close. I did want to mention, we showed how the Dow was probably, just the most consistent uptrend today. And over the last 2 days, just look at this nice kind of steady incline while other indexes have struggled a bit. I just want to show you this. This is the market movers widget, but just looking at the Dow members, when you see an index like this moving up, I think it's important to just look at, look the levels down and just see what stocks actually drove those gains. Amgen, the best performer out of the 30 Dow members, up almost 7% today, 6.5%. This move does push Amgen back above $300 a share. Last, year to date has been remarkably strong. Look at how December finished quite weak. And then so far year to date, market just turned on a dime. This is looking at Amgen, right? Downtrend really into the end of last year, and then just completely reversing to the upside so far year to date. That has taken the momentum from oversold to overbought in about 6 weeks. It has taken the relative performance from clearly underperforming to now clearly outperforming. Excuse me, taking today's move, taking the Amgen back above the 200-day moving average for the first time since November. So nice recovery from a stock that looked all but dead in the water back here at the end of December. And I'm noting how we lined up with those April 24 lows, ended up being a pretty good support level. We've now bounced off of that point. So, I mean, at this point, charts back to pretty constructive. Getting above the 200-day moving average is pretty good. Now, NVIDIA, on the other hand, gapped lower in January. We can see from a gap around 145 down to around 125, traded down around 113, we'll call it. So a nice update today, but we're still kind of within this range that we've been in for the last week and a half since that big gap lower on earnings. Boeing number 3 up 3.2%. Again, still range bound if you look at the last 6 weeks or so. So I think some of those names like an Amgen, real nice recovery. Others kind of trading higher, but still within very much a range. So I would always encourage you when you see a 1 day percent change or something like on the heat map, a 1 day change, really look at the chart and think about what this day's move means relative to the longer trend and look for more significant trend changes to think about. Breadth very quickly, pretty strong positive breadth, I would say overall. The S&P members about a 7-to-3 ratio, right? So 70% of S&P members finishing higher today, about 30% declining. You can see all 5 of the major U.S. indexes saw positive advanced decline data, so more stocks up than down. Breadth conditions have been, in some ways steadily improving. In other places, kind of chopping around. We're still above 50% of S&P members above their 50-day moving average, and that remained above there after today's nice uptrend. So we'll see, right? I mean, I think overall the breadth remaining strong would be one of the more constructive things to observe in the markets here going into February. Strong breadth usually means a strong market. All right, looking at the Magnificent Seven and friends, you can see NVIDIA, the top performer, up over 5% today. Netflix, number 2, up 1.6%. Microsoft up slightly, same with Meta. On the downside, Alphabet. Alphabet earnings did not go well. And I think that's this is the danger, which we talked about going into these weeks where it's a lot of Magnificent Seven earnings. Last week, we had a bunch of 4, I think, of the 8 companies reporting. This week, we've got another couple. And the danger going into this earnings season is negative earnings from some of these big growth names, because I would argue the market in terms of the benchmarks getting significantly, meaningfully higher from here means you have to have strong earnings. You have to have additional catalysts to fuel expectations for further growth. And the problem with companies like Alphabet, you're not getting that. You're getting sort of very measured expectations about things going forward, a little more tempered, outlook in terms of growth prospects for the company. And so the market taking that as a pretty big negative. Dinging Google down 7.3% today. That's the worst performer in the group. Excuse me. Tesla continuing to struggle, down 3.6%. Amazon also not doing well, down 2.4%. Amazon's still not bad. I mean, yesterday we made a new closing high above 240. Today we're just pulling back off of that level. So, the short-term trend in Amazon is still positive, but today ended up being one of the worst performers out of this basket of mega cap growth names. All right, let us go to the market carpet. And as you can hear, apologies that I'm not feeling 100% yet. I'm getting better, which is good. But boy, this is a long slog. And I've talked with a number of others that have been fighting this version of the flu that sounds like we have. And boy, it's just a long runway. So it's good to have a long runway for your portfolio and your retirement. Not as good to have a long runway for recovering from an illness. So fingers crossed we continue to improve from here. And I can keep doing the show with a smile on my face for the most part. The market carpet, by the way, you get kind of this axis of evil look. You get right in the middle, Alphabet, Amazon, Tesla, just a trifecta of really ugly returns. And then if you cover that up, just literally put the palm of your hand over the middle of the screen and look to the left and the right, not a bad day. Excuse me. The problem is those big red boxes have a big weight in the major benchmarks, and that's the issue here. Alphabet, as we mentioned, down the most out of the Magnificent Seven names. Amazon and Tesla, those are your 3 worst performers, and that is certainly keeping things like the Nasdaq 100 underperforming things like the Dow. So that sort of axis of evil figure in the middle stands out for me for sure. The strength in defensive sectors stands out to me as I'm reviewing this a little earlier. Look at REITs, look at utilities. Not bad, and a lot of green in those particular sectors. Real estate ended up being the top performing sector today. And one of the charts that I grabbed, what that we'll talk about in a bit during the chart review, is the fact that one of the checks in my bull market top checklist, one of those signs of a major top likely occurring, is an improvement in the relative performance of defensive sectors. When investors go full defense, when they stop wanting to own offensive names and sectors like industrials or materials or consumer discretionary, and they want to go into things like real estate or consumer staples, like big defensive, higher yielding names, that is often the sign of a big defensive kind of risk off move. And you haven't been seeing that, excuse me, on a relative basis to any large degree. We've seen that bits and pieces on like a day like today when REITs are at the top of the list. But I would say watch those sectors, because more days like this where you see a lot of green in those sectors, that could imply that assets are rotating to those particular areas of the market. Also noting, within technology, while you have AMD, which dropped a lot on earnings, kind of similar to the Alphabet issue, just getting dinged after earnings. The rest of technology, not bad. You've got some random names that are kind of flat to down, but overall, this wasn't a bad day with NVIDIA and Broadcom both up a pretty good amount. You can see a number of other names within there having decent up days as well. So overall, the market carpet, I mean, overall, not too bad. And I would say the breadth, with the advanced decline data, more bullish today. Certainly, that's what it seems like. I just think the bright red in the middle is kind of skewing your perspective and making it look like a pretty bad day. And this shows you how much those big names can weigh on the benchmarks, right? There's such a big weight. And to be honest with you, to make a comment, because a number of people have asked about the market carpet and just how this visualization was constructed. It's the boxes are scaled based on market cap. So the larger the market cap, the bigger the box. But it's not perfectly scaled, meaning one pixel does not have a particular market cap amount. Because if you would do that, if you would literally weight the boxes by the size of the market cap, you would have 10 huge boxes and then a bunch of tiny boxes. And the smallest ones you wouldn't be able to see. Like Ross Stores wouldn't even have a pixel because it's so small relative to the dominance of those big names. So it's sort of it's graded on a curve. It's kind of a scaling, but the biggest stocks are scaled down and the smallest stocks are scaled up. So it's more of a linear kind of weighting, just so we can see all the tickers and see all the boxes on here. So while it feels like this isn't that big of a box, in terms of their weight, it's actually much more significant than the size of these rectangles would actually visually imply. I hope that makes sense if I was unclear. Can appreciate the questions that are coming in. I see them coming in on some of the different platforms we're streaming on. Thanks for keeping them coming. We'll try to grab a question or two at the end. Excuse me. And then anything we don't get to, we'll put in the mailbag for Friday's episode. All right, we mentioned when we showed the returns of Bitcoin today, how the major averages, the S&P and the NASDAQ, range bound, and that is my main thesis here in terms of the equity averages. We're sideways, so I don't have a problem if you have long equity positions and you're still owning them, right? I mean, if you have exposure to the S&P in some way, which you probably do, do I see any reason on this chart to be liquidating a position based on the technical setup? I don't. Do I see a big bullish breakout that suggests we want to, follow the next big leg higher? I also don't see that. And I think that's the reality, right? There are periods where the market is clearly going higher, right? While the trend is up and we have a pattern of higher highs and higher lows. This is when my market trend model tends to be bullish across all time frames, and it's a very clear uptrend. Those markets in a lot of ways are super easy because the chart's going up, we keep making higher highs. When we pull back, we make a higher low. We often find support at an ascending 50-day moving average. Those are easy bull market trades. And I would say, consistent bear markets are pretty easy as well. It's pretty easy to find stocks that are in confirmed downtrends that rally and fail to make a new high and just keep going in a downtrend phase. This one is definitely not either of those. This is more of a question mark kind of trend. We're not going up anymore by the fact that we're not really making new highs, and the attempts to make a new high above, excuse me, that early December high around 6,100, those attempts to break out have failed in mid January and late January. breakdowns have also failed, right? So that breakdown, which we noted, I'm leaving this on here just to remember what I was thinking at this particular point. Definitely saw a breakdown leading to further deterioration. Did not continue, right? The market spent a day or two below 58.50 and then rotated right back higher. Now we're sort of back within this range, and a consolidation phase for me is anytime you can draw a big rectangle on the screen and it sort of captures most of the price action over a period. So the rectangle shape that you see on your chart, that's a consolidation phase. That basically says the market's in agreement. Buyers and sellers are kind of telling you this is where stock should be at. And until there is some new catalyst, until there's an influx of buying power or selling pressure, unless there's an influx of some new catalyst, right? Some news event or economic data or something to shake investors out of this equilibrium and start to make people think that some change is afoot. We're sort of going to remain in that trend. Think of Newton's laws of motion. This is the law of inertia, right? That things are resting, they're going to remain there. I'm butchering his law of inertia, so sorry for that. But basically, object in motion tends to stay in motion, and object at rest tends to stay at rest. We're kind of at rest, right? The market is waiting, licking its wounds, holding steady. And I say at this point, until we break out above 6,100, below 58.50, we're in wait and see mode. So for me, that doesn't mean, get rid of positions that aren't going lower. As long as we're holding there and I'm not underperforming, I'm probably very happy with those. But if I would start to see things break down, that's where I would unwind them. And I'm not seeing the breakdown happen just yet. So for now, we're remaining, I think, sideways. And I think that is the general trend. What's interesting, and I will point this out, that if you listen to financial television, I will never forget the first time I went. I won't even mention where it is, so no one tries to find it. But the first time I went on financial television, and I remember I was asked what I think the market's going to do, and I gave kind of a description that I just gave, kind of gave a neutral. I was like, there are some positive things, some negative things, but at the end of the day, this is netting out to an equilibrium, the market sideways. And that ended up being correct, right? Over the next 6 weeks, we didn't, we kind of just chopped around. But I remember being walked to the elevator and the host said, hey, really appreciate you coming on the show. And the next time you come on, can you just be really bullish or really bearish, like really take an aggressive stance? And I got in the elevator. I'm like, that just doesn't, I can do that. But boy, that doesn't seem right. The right answer, I truly believe I gave an intellectually honest answer, which is like, it's sideways. Very few people go on TV and say the market's going to be neutral because you don't get invited back. That's the problem with financial television and interviews, is you have to have an aggressive position or it's not interesting enough for the host to want to have you back. And so I would hesitate. I would say a lot of investors in this kind of environment, a lot more investors are probably more neutral than you think, because they can't go in public and have an aggressive pound the table, we're going sideways argument, because people tune out and they want, if it bleeds, it leads. They look for something that's more scary or more euphoric, and that's what people want to read. But I stand by the conclusion. We're going sideways, folks. All right, newer Dow theory. I just want to highlight this because we're not quite to a what's called a bearish non-confirmation, but we might be getting to one, and that's why I wanted to spend a few moments on this chart. Now, the newer Dow theory, as a reminder, is based on Charles Dow's work, literally from the Dow Jones Industrial Average, and from Wall Street Journal and Barron's. That Charles Dow, 130 some years ago, wrote a series of essays where he literally laid the foundation for modern technical analysis and classical technical analysis, to be honest with you. He basically described how one of the things that you can do to understand and define the strength or weakness of the markets is by looking at two main parts of the economy. In his opinion, the producers of goods, the Dow Industrials, and the distributors of goods, the Dow Railroads. And if they're both breaking to new highs, that's bullish. If they're both breaking to new lows, that's bearish. If one is breaking out and the other is not, that's a bearish non-confirmation. If one of them breaks to new lows and the other does not, that's a bullish non-confirmation. So the idea is when the averages confirm one another, that confirms the current trend. So when both of these are making new all-time highs, that's bullish. And we saw that in October of last year, again in November, and really December of last year, we saw that. Now, what we may be setting up for, and I think it's too early to make this assessment, but I would be watching to see how this plays out. excuse me, we could be getting what's called a bearish non-confirmation. And what I see maybe happening is the NASDAQ 100, the equal weighted NASDAQ 100, which is my modern version of Charles Dow's work, is looking at an equal weighted S&P and an equal weighted NASDAQ. The equal weighted NASDAQ making a new high, the equal weighted S&P not confirming that new high. And if we would get the QQQE, excuse me, breaking above its December peak, but the equal weighted S&P not doing that, that would be a bearish non-confirmation. That would be a major bearish signal. The last time we actually got that bearish non-confirmation was in August. It did not play out, to be totally upfront with you. Looked pretty negative. Market had sold off in August for sure. But by late September and then early October, that non-confirmation was negated by the fact that both of the indexes made new highs again. And that's what sort of signals that the non-confirmation was not true, and that overall it was just a pause within the uptrend. So I would say keep an eye on this. If we get a similar non-confirmation, while it doesn't, excuse me, guarantee a major market top, it would be something concerning that has occurred at many other major market tops. All right, bond prices. Yesterday, we looked at the 10-year Treasury yield, $ TNX. We talked about the trend line channel, the lower trend line using the major lows in the $ TNX over the last 6 months. Today, I'm going to show you the TLT. So it's kind of like that previous chart, excuse me, but flipped upside down. We can see from the September 24 high in the TLT, we have made lower highs in early December. And then for now, it looks like we're making another lower high here in late January, early February. You can see that I could draw a parallel channel, which I'll do now. So most platforms allow you to do a parallel channel. It just depends on the platform, how you do it. On stock charts, you hold down, I know it on a Mac, you hold down the command button and tap the trend line and drag it, and you get another parallel channel. But that can be helpful to just show how, it's a parallel move, lower highs, lower lows. So what's happened here is, there's been a trend line from the September and December highs that lines up just above current levels. Also note how during that downtrend channel, the RSI has been down in the bearish range. So we've gotten oversold when we make new lows. We've not gotten above 60 on counter trend rallies. That is the mark of a trend in a downward phase. And then what I would point out is the fact that we may be changing. I think it's a little too early to determine, excuse me, but I think this might be that sort of moment where bond prices start to change their trend if, and this is a big if, we break above trendline resistance, the RSI powers above 60. Currently, the RSI is pushing above 60. Trendline not quite being broken, but very, very close. I think if the TLT breaks above the 200-day, which is around 91, that would indicate maybe a big change in the trajectory of bond prices, which have been going lower. My guess would be, because the fact that bonds have been going down while stocks have been rallying in Q4 going into the beginning of the year, bonds have been rallying here in January as stocks have kind of tapered off a bit. I'm wondering if this is the beginning of a rotation away from stocks into bonds, at least in the short term. Getting out of this channel on stronger momentum would certainly tell me that is a very real thesis I need to consider. Until we break out of this channel, I'm just going to assume that trend continues. And that's a lot of what technical analysis is. In terms of the version of trend following that we talk about, is defining the trend and then following the trend as long as possible, assuming that trend is going to persist until the evidence tells you otherwise. And I think we're pretty close to the evidence telling us a bit otherwise on the chart of TLT. I think that's something we'll have to keep watching through this week as well, the 10-year yield also. All right, when we're looking at defensive sectors, I've referred in the last couple of weeks a number of times to my market top checklist. This is a group of indicators that I watch, have done some work on historical market tops, look for some consistencies. And one of the things that I found pretty consistently, particularly in more painful bear market phases, is that you have an improvement in defensive sectors. And this happens for a reason, because institutions that have to own stocks, that can't go to cash, they have to be fully invested. So what do you do if you think the market's going to go lower? What you do is you rotate to what are called low volatility sectors, defensive sectors, higher income sectors, sectors that don't tend to move as much. They have lower volatility, meaning if the market goes down, they'll probably go down less because they just have lower movements. than the broader indexes. So they have a low beta, right? A higher beta means a higher volatility relative to the benchmark. So they tend to have lower beta, and they tend to be more conservative, and they tend to have a more significant dividend component. So that you can at least get some income from the dividends, and then ride out this period of market uncertainty. So you think the indexes are going to go down. You want to own things that are probably going to go down less, and that also are going to give you some income along the way. These are the defensive sectors you would probably rotate to if you're an institution. From the top, it's utilities, healthcare, consumer staples, excuse me, and real estate. These are the relative performance lines that I'm showing you. So the sector ETF versus the SPY. So if the lines are going up, that sector ETF is outperforming. If the line's going down, these are underperforming. Now you can see that over the last 6 months, all of these have been trending lower for most of that period, right? Real estate, consumer staples in particular, healthcare, honestly, and utilities as well, right? All of these have been trending lower over the last 6 months. But if you look what's happened year to date, healthcare actually starting to improve. Utilities probably flat. Consumer staples probably still down. Real estate kind of flat. Now, what I would say is this is one of those really key charts to watch. Sometimes charts give you a signal. I don't think this is a chart telling you a signal just yet, but it's one that may signal very soon. And this is why I have it in the regular rotation of charts that I look at every morning, because I want to not miss that reality when defensive sectors start to improve on a relative basis. I think this could be a key chart to watch through the first half of 2025. Given all the uncertainty, given all the instability, are institutions rotating more defensive? For now, I'm not seeing that happen in any large degree. I'm seeing little bits of it day to day on a day like today when rates are the top performer. But the relative performance is really not improving. Look back at like July and August for what happens when institutions get more defensive. And so again, for now, I'm not seeing the signal. I think this is one of those charts to watch for that signal perhaps to evolve. All right. We'll look at a couple individual stocks. I'll take a question or two. We'll be good to go. NVIDIA, for now, I feel like I'm going to broken record this chart and bring it up every day and just point out the fact that we're still within the gap days range. And what I mean is we had this big gap from 142 to 125, we'll call it. We traded kind of in this range on that day. That was January 27th. And from there, we spent almost the entirety of the time within that day's range. So what this tells you is, NVIDIA gapped lower. This was after the DeepSeek AI, that Monday big sell-off. We've not gone down any further. So was that the beginning of the end of NVIDIA? Not by the technical view at this point, right? And we're not just continuing to go down from that point. Was that just a one-off scare and we've recovered right back? Also not true, because we're not back up to where we were before that announcement. We haven't even touched the price gap that was established on that day. So again, I think this is a market in a period of indecision. I think it's still a big question mark in terms of what the what the move is after this point. I think with this sort of thing, again, anytime you can draw a rectangle around the price action, you look to see which way we break out. For now, we can see we're still within that day's range. We can see that the momentum is essentially neutral. We've been between 30 and 40 and 60 for most of the last 8 weeks, which tells you there's an absence of significant momentum on either side. I think NVIDIA is kind of neutral right now, sort of waiting to see what happens. We still haven't had sort of an impulse move after that gap lower. I think with semiconductors as a whole, also sideways. I think we're range bound between 235 and 260 on the SMH. We'd had a nice update today. It was up about 2.4%. That takes us right back to the 50-day moving average. We're back above the 200-day as of today. That's all not bad, but we're still well within this range we've been in since late September. I think still to be determined there. Now, is Alphabet a great chart anymore? Maybe not, right? We went from making a new all-time high yesterday to gapping lower. So, no, that's not good. Better would be gapping higher a la Palantir. That's what a nice earnings win looks like. This was not an earnings win. This was a concerning, earnings break. But here's the thing. How much did Alphabet actually break down today? It's down over 7%, but it's still holding an ascending 50-day moving average. It's down over 7%, but it's still holding the most recent swing low. So the problem when you have a stock going vertical like Alphabet has been doing over the last couple months is you can have a big down day like this, but still be totally fine from a technical perspective. I would describe this chart as totally fine. I think we're holding the right support levels for now. We had basically what's called a doji candle as we test support and test the 50-day moving average. There was not a ton of selling after that gap lower. It was more sort of, circling the wagons around that particular price level. I'm watching this, particular point. I think we break down any further through the remainder of this week, all of a sudden that looks like a much more questionable chart, breaking support. And I think you have to, avoid riding it any lower. But for now, it's not bad. So if I still owned Alphabet today after yesterday and today's gap lower, I wouldn't feel great about today's price action, but I probably wouldn't be that scared because we're still holding up quite well. Remember, that's why technical analysis is done on multiple timeframes. That's why while we think about one day's drop, we also think about what it means for the overall trend. The overall trend on Alphabet has not changed even with today's gap. And that's what makes it kind of a unique, big gappy name, but also still okay from a technical perspective, holding support, holding moving average support as well. Disney earnings today. It's not technically a bearish engulfing pattern, but it is a bearish outside day where we basically had a wider range and a down close today versus yesterday. That is a negative sign for Disney. During the day today, we did trade briefly above that early December high, but did close back to a new low for the last week and a half or so. We're still above support around 106. We're still below resistance around 118. As with many charts, I think right now it's neutral as we wait to see where this plays out. If you ask me to vote one or the other, you have to be bullish or bearish. I'd say bearish by the fact that we're failing to get above resistance and failing at an RSI of 60. So that generally does not say bullish chart to me. That says more neutral chart at best, but it's not breaking down too much. Now, you have this gap here around 108. You have that low around 106.50, we'll call it. I think that's the level where you expect some potential support. We break that, I think that's a pretty ugly chart all of a sudden. For now, it's just not a good chart anymore. And I think the fact that it's stalled out with the momentum stalling out where it normally does in a bearish phase has me thinking more negative than positive in the short term for Disney. Finally, Uber. Uber trading a little bit lower. I just want to highlight this as a stock trading up to the 200-day moving average and pulling back down. Yesterday, we look at a stock closing right at its 200-day moving average. This is after coming off of a low around 59 in mid-December. Over the subsequent 6 weeks or so, we get up to $70 a share. We test the 200-day moving average for about 2 weeks. We're kind of threatening to get above that level, but we're not able to do it. So when a stock can't get above its 200-day and the RSI can't get above 60, that tells me it's just not the right time. Someone once said there's plenty of bad times to buy good companies, or some version of that story, right? Good companies don't always make good charts, and I think that's the reality. At the end of the day, technical analysis is a timing tool. It's trying to tell you when the conditions are good and to expect a likelihood of further appreciation or of a directional move that's going to help your portfolio. That's how I think of it. And I would say when a chart like this fails to complete that move that you would expect, I think that's where you have to be skeptical. It's not broken yet, right? We're still holding the swing lows. We're not down that much from the recent high, but it's just not breaking out. Again, this is one of the many names kind of languishing and kind of waiting and seeing. I think the stock above 70 is a pretty constructive chart and may set the stage to retest those previous highs, but that's the trigger I would wait for. With a chart like this, I set an alert, tell me when Uber gets above 70, and then I go find something else to do and wait for that to trigger. Finally, I had a bunch of charts that were kind of questionable, kind of sideways. I'm like, let me find just a chart that's in a nice, good uptrend. We talked about Palantir earlier. I keep mentioning that. How about Cisco? Look at the chart of Cisco since August of last year. This is when the markets as a whole were struggling in July and August. Cisco actually double bottomed here from the June into the August lows, gapped higher. Excuse me. And then from there, it's been a fairly consistent pattern of higher highs and higher lows. Today, we made a new all-time high, getting above 62.50, or new 52-week high, that is, after testing the 50-day moving average a number of times over recent months. I would also note how the RSI remains above 40 on pullbacks. That's a constructive chart getting more constructive. I think charts like that, long and strong, you assume that trend persists until it doesn't. All right, we'll take a question or two, and I appreciate so much those of you guys watching the show and asking some question. Christine, excuse me. Dave, is there a time limit that you can use support resistant trend lines from? For example, would levels from pre-2000 still be relevant in 2025? That is such a thoughtful question, Christine. I appreciate you watching and I appreciate you asking about that. Is there a time frame? So I would say anything from pre-2000s, I would be hard pressed to find a support or resistance level pre-2K that is relevant in 2025. If you can find one, folks, and let me know, I'd be interested in looking at it. I doubt it though, because the market has a memory but doesn't have a perpetual memory, right? The market does not have a photographic memory, right? Some people do, but most people don't. So I would say most investors are thinking about recent levels because they're thinking about buy entry and exit points. They're thinking about their buy and sell points. They're thinking about key levels that jump out. So like Cisco 44 makes sense, right? That is a recent support level that I think would still be relevant. And if we would have this big downturn and we get back there, I would think that would be a very meaningful level. But, if we go on Cisco back, many moons, is this high important? This is the 2019 high. That has absolutely nothing to do with what's going to happen in 2025. I can't imagine that that's true because it's no longer relevant. There's been so many other points that have been relevant for investors, right? So what I would say generally is you want to read a chart right to left in terms of importance. So the current data is the most important. The further you get to the left, the less meaningful it is. The further that you're hitting other points to get back to some other point, the less meaningful that is because newer information, newer things have happened that have changed the configuration, right? This was a significant high until the next one, All of a sudden, that's the significant high that people think about. That's why we often talk about like the all-time high, right? Cisco going to an all-time high. That's when I could see it being relevant. If something is, finally round tripping and breaking above the level it reached in March of 2000, that's the only scenario where I could say, yes, some level back then is probably important. Should it impact your buy and sell decisions? Probably not. I mean, it's more of a, interesting data point, kind of a did you know thing, but less is it really going to help you identify trends. With trend lines, it's a little different. And I actually would tell you that with trend lines, it's an interesting one because I've had some really good conversation. I don't have one offhand to show with me, but I want to say the NASDAQ. I want to say someone had okay, I'm going to give me, if you'll indulge me, because it's my live stream and I'm not turning it off for maybe, I don't know, another minute. Let me look, because I think I had a chart of a really long term. There we go. Look at that. It's the first one that came up. Don't you love when things work out? Okay. This is a trend line, and I feel like this was, I'm going to say, hey, who was this? One of the guys from Investing with IBD, I want to say, when I was on the podcast there. I feel like we talked about this, maybe Hammy or one of those guys. I don't know. But someone there, I feel like, shared a version of this chart. And I was so impressed that I, created it and saved it on this chart list, which I call historical charts. And anytime someone shares some really cool, long-term chart or historical chart of a particular time, I'm like, ooh, I might refer back to that. I put it in this chart list, which I just call historical charts. This is the one. This is a very long-term trend line. This is the NASDAQ Composite Index taking the 2009 low, connecting that to the COVID low in 2020. Look how that lines up almost perfectly with the late 22, early 23 lows. And the argument with this chart is this is how much the market can go down and have the secular trend still be positive. And we talked about this chart kind of back in this period where it's like, how bad are things in 2022? And I remember this chart, it was like, they're still not that bad because look, we're still holding this trend line from the 09 lows. And I was like, ooh, okay. So, if that's the kind of framework you're talking about as a way of measuring the overall secular trend and recognizing long-term evolution of trends, 100%. This little trend line and connecting it to where we're at now, I think has no meaning, right? Some little tiny kind of minor trend line. No, I don't think that matters. Major long-term trend lines taking significant highs or lows. That's the only kind of trend line example that I would think would be relevant to present day. And it's less, again, it's less about a timing tool, because I think a monthly chart of the NASDAQ is not really going to help you time these particular moves, but it is going to help you put things into context. And that's where I think really long-term charts and really long-term trend lines can be quite helpful. Thanks for that question, by the way. That was a really great question. Made me think a bit and allowed me to find that really good long-term chart of the NASDAQ composite with the trend line. So I appreciate that. Folks, thanks so much for watching me today on the live stream. And thanks so much to those of you watching the replay later. As a reminder, we broadcast live every day after the close, 5 p.m. Eastern. Thanks for bearing with me as I'm getting through a sickness here in the household, but happy to bring the show to you. We're planning an all mailbag episode on Friday. So any questions that came up as you're watching the episode, please put a comment below and let me know. Hope to feature your question on the Friday episode. For Market Misbehavior, I'm Dave Keller. Have a great night. And remember, it's always a good time to own good charts. Take care, folks.